and we're going to jump right into lecture today. So let me just make sure the recording is actually showing my screen. Yes, it is. Okay. So the lecture concept today is going to be pyramiding in market maker models. Right. So pyramiding in market maker models. And this is going to be the idea of really mitigation. Let me a couple concepts we're going to talk about, okay? One is mitigation. Two is order blocks and FEGs as pyramids. And three is going to be premium discount, or what I like to refer to as the pyramiding range. Okay? Three major concepts. If we can get through all three of these, there's going to be success in understanding what pyramiding is, how it works in context of market maker models. Oops, didn't want to delete that, right? And how you should be using it in your trading. Now, just as pyramiding exists, right, which is adding to a position, pyramiding can also be thought of as independent positions being added, in isolation. So you could be adding to one position. That's one way of pyramiding. So pyramiding can be adding to a established position. This is a form of averaging up, right, which is different, not DCA, right? This is actually increasing your average. Pyramiding can also be thought as adding unique positions, right, along a price leg or implied dealing range. Depending on how you like to trade, you can either be adding to your position, increasing your average cost, and therefore increasing your size, or you can be exiting your position and re-entering on a valid setup, right? Pyramiding therefore involves a level of time frame alignment as well as a strategy of position sizing, right? In case you want to look at things like your average cost or trailing drawdown, right? Pyramiding involves multiple of those kind of pieces or components. Okay, so now that we've established what pyramiding is, let's get right into the first idea of pyramiding, which is going to be mitigation. Okay, so mitigation or mitigation areas are where we are going to look to pyramid, okay? So mitigation areas are the following. You're going to refer to this statement: old selling equals new buying, or old buying equals new selling, okay? Now this is in function of mitigation. So as price returns to old areas of selling, there will be transactional adds or buying to the market, right, in the form of a mitigation or breaker block. Likewise, in areas of old buying, there will be new selling, right? So these two statements can be inversely flipped. So how do we actually visualize that? So if we have old selling, what is that going to look like? What type of candles, right, are facilitations of sell orders in the market or order pairing sells? Up close or down close candles on the sell side of a curve? Someone tell me. When we consider there to be a bearish order block, right, on the sell side of the curve, what type of candle is that? What type of candle is that? Where do we reaccumulate shorts on the sell side of a curve? Up close candles, right? Now this is kind of not intuitive always, where we think that when we see displacing candles lower, the market is selling off. What we have to shift our perspective to now thinking is that the market is being distributed lower in down close candles. So this is offset distribution, and it's actually being reaccumulated or reshorted for a new leg of distribution in up close candles. So up close candles, right? Old selling equals new buying is equivalent to saying that bearish order blocks will become bullish breakers, okay? And this statement that old buying is equal to new selling is tantamount or equivalent to me saying that bullish order blocks will become bearish breakers, okay? Okay, so a bearish order block will become a bullish breaker, right? So a bearish order block right, is a candle that looks something like this, for example, using this 4-hour chart. A bullish order block or a down close candle could be referred to something like this, okay? Now the reason why we're looking at this from a conceptual standpoint is because we have to understand fundamentally what mitigation of the market means, right? Not only is mitigation an area where you can scratch a position as it returns back to a value that is equilibrium with your entry, right? It's where you entered. But it's also usually referred to by the algorithm as a new point of institutional support and resistance. So, old selling will only become new buying, and this statement will only be true on what side of the curve? Again, there has to be a context to why we're saying this. On the buy or the sell side of the curve? Someone tell me. Yeah, I'm seeing some buy side of the curve, right? This will be on the buy side. I'm just gonna, OTC is of the curve, okay? Now, old buying acting as new selling or the creation of bearish breakers will only be on the sell side of the curve. So as we look at this from just a conceptual standpoint, we're not actually looking at any TA yet, right? We're understanding that in a price leg, let's look at this price leg here, okay? As price returns back in to this, right? This is going to be our bullish breaker, right? Which is the same thing as saying our old bearish order block. Those two statements are equivalent, okay? So our bullish breaker that we can observe right here, this bullish breaker, this up close candle, is the same area as defined algorithmically by an old bearish order block. Now, why am I calling it old in quotes? Because we are no longer seeking sell side distribution, and instead we are offering buy side distribution. So on the buy side of the curve, targeting this pool of liquidity in the form of external range buy side liquidity, okay? We're offering buy side liquidity at the external range. This old area of selling, remember, what happens inside of a bearish order block? An ICT bearish order block is defined as the series, right, of up close candle in a bearish price leg, okay? Right? We expect that these up close candles will offer resistance as the market is reaccumulating and redistributing. So as price trades through this old bearish order block, we are getting a sign of a change in the state of algorithmic delivery, which is naturally expansive of the topic of support and resistance. This is true support and resistance. This is an area that, if you can justify as being an old area of selling, will act as a new area of buying in the market as price comes into here. We have positions that look like this, right? If this is an old area of selling, let's say a position looks like this, okay? As price returns back in to a bullish breaker, or in this case, a order block that will fail, we have positions being mitigated, right, at break even or around break even. Now, I want you to consider what mitigation even means. If we are short, right, if we are net short, the ES in this case, and price returns to our original entry, okay, which is going to be in this case the order block on the sell side of the curve. Stick with me, it might be a bit confusing, but I promise it'll make sense. What is the associated action, right, to mitigate our position? Are we 1, buying to close, or are we 2, selling to close? I'm going to put a quick poll in the chat, and we are going to vote on that, okay? I'm going to copy and paste this. Buying to close, selling to close. Okay. Give everyone a chance to vote. Okay. As people are voting, I'm going to keep going in the interest of time. As price refers back to our principal position entry, meaning not any ads we've had, but the principal position we take is right here. Principal just meaning that first position we take is here. As price refers back to that first positional entry, we are mitigating through the action of buying to close. Buying to close, by definition, supports the thesis that mitigation areas of the market are old areas of selling becoming new areas of buying. Does that make sense? We need to convince ourselves of this in pure algorithmic theory and price action delivery, that this statement should be true. And it does make sense if we consider that the option that traders have, or institutions or positions have, to be mitigated rests in buying to close, right? As price returns back to this break even or scratch level. That buying to close, in fact, endorses the statement that this area in a classic buy program, right? Not a consolidation of sorts, but a buy program, is going to be an area that new buying happened at the old selling, or old selling was paired with new buying because individuals' positions are being bought to close, so there is new buying or mitigation. That is the definition of algorithmic mitigation, is to scratch a position with a new buy to close order. Fantastic. So if we understand that, we can now draw the same parallel for an area of mitigation on the sell side of the curve, okay? Again, we'll just keep the concepts up here. And the reason why I focus on the theory is because you really need to believe the theory, right? To believe that what you're learning holds its weight. So what we're going to look for, again, is an old area of selling. Or of buying, sorry. Whoops. This is a bullish order block on the buy side of the curve. As you can see, this is a bullish order block, which is the same thing as a bearish breaker with sell side delivery, right? Under the context, I'll just say UTC is under the context of sell side delivery. These are equivalent statements. This bullish order block under the context of sell side delivery is now a bearish breaker. The down close candle is a bearish breaker or a bullish order block. As positions return, if you are net long here to this high, and you do not close at the external range high, as positions return back to the entry, we have an option as an institutional trader to mitigate underneath the sell side delivery. At this point, what are we doing? Buying to close, selling to close. Which one? Now, I'm not going to put another poll in the chat. Selling to close. Exactly. These mitigation areas are key levels where there is a handshake between buyers and sellers and a willing counterparty of liquidity that the market can utilize in the form of order mitigation. Not potentially new orders being propagated or entering the market, but old orders being scratched as mitigation zones, which is why I like the term mitigation block as opposed to breaker block. I like the idea of thinking of this, right, algorithmic delivery, in terms of mitigation, because then there's a logic that is consistent. So in this case, we are selling to close, which supports again the idea that old buying in the market underneath the context, right, of sell side delivery, right, supports bearish breakers being the area of new selling or order mitigation. Okay, cool. So that is my crash course in what mitigations are. Now, the natural implication of that question is, well, why do we care about that? Right? Why do we care? Mango, can you please sit down? Thank you. My dog's on my bed. Why do we care about these areas of mitigation in the first place, right? Why is Afiz teaching me this? Why does he think it's so important? We're going to touch on why underneath the idea of pyramiding or order or positional entries in the first place. So we have this context. I'm going to screenshot this, put it in the chat, and then move on. Okay, delete this. So why do we care about these zones of mitigation? What I am going to convince you of is that the best pyramid entries or new positional entries will have the two following criteria. One, they will be at an area of market mitigation. This means under the context, right? So under the context of buy-side delivery, bullish breakers will be ideal area. Under the context of sell-side delivery, and the reason why I'm saying under the context is because if you're on the wrong side of the curve in your analysis, this will not be true. If you are trying to add to a short, right, in down close candles on the buy side of a curve, you're actually shorting into an order block. Good luck, right? Down close candles on the buy side of the curve are going to support price higher, not offer new selling lower. Okay, so under the context is an important statement that is often missed because we love to think in terms of patterns. We need to be able to frame what the context of delivery is first, which is why I'll always start with the narrative. But under the context of sell side delivery, bearish breakers will be the ideal area. Okay. And this is going to be for new pyramid entries or a positional entry. Whatever you want to do, however your risk management works, that's how you can approach taking a new entry. Okay, what else will they have? What's the second criteria? I said there's two. These entries will be in the discounted or premium areas of an implied dealing range, an IDR, which I have taught you this concept. Fees has taught this concept to you as swing grading, okay? The entries that are going to be ideal for new positional entries or the best pyramided entries, meaning you want to take a new entry in that delivery higher or lower, are going to be under the context of these PD arrays, bullish breakers on the buy side of the curve, bearish breakers on the sell side of the curve, as well as being in the discounted or premium areas of an implied dealing range. Do those two statements make sense? Does anyone have questions about those two statements? Because I need you to understand those before I can move forward. Mango, can you please sit down, bud? My dog is just like, yo, I want to be involved in this lesson. I'm going to move to my desk. Makes sense? Makes sense? Cool. Okay, so those are going to be our two criteria and our working kind of definitions moving forward to actually explain how we end up taking pyramided entries. So let's keep going. Plug in a computer. Now, this lecture, of course, is going to rely on you understanding several concepts that I've taught before, and that's why, it's a bit more complex, and it's not something you'll probably understand until you go back and you backtest it and you look and prove it to yourself. But these are the two criteria, okay? I'm going to copy this image, put it in the chat again. Perfect, let's keep moving. Mango, down, please. Down, bud. Down, please. Down, please. Down. My dog is acting up. Okay, so get rid of this. Or actually I can keep this here. We can just put it up here, make it a bit smaller. Okay, so now let's look at how we actually engage the market using these two criteria. So let's start with this price leg in here, okay? We're gonna start with this last week's essentially price action on this 4-hour chart. We can also look at the hourly chart if we want to see a bit more, right? We want to get some more examples. So let's take a look at the buy side delivery, right? And see how we could approach using these two criteria. So the first thing we need to do is cement our implied dealing range. This implied dealing range is going to be from our assumed smart money reversal, which we always will have for any time frame fractal market maker model, which I teach you. This is our SMT, right? And this was at the 60-day lows. Okay, that's why I longed ES all week. If you guys noticed, I was trading ES because it just had a more bullish divergence. That's neither here nor there. But we do know we have an area that can offer our smart money reversal right in here. So what we want to do is we want to anchor, right? From our smart money reversal area, we want to anchor our implied dealing range low to our implied dealing range high, which is this buy side liquidity terminus, okay? Now, why am I choosing that buy side liquidity terminus? Also, I'm gonna hide my indicators so we can just see this. Right, the reason why I am choosing this high is because if you look at the daily chart, that is the external range high from this smart money reversal. So it's the first draw on liquidity in terms of being an external range because we're looking to deliver from one end of the range to the other, potentially even higher. But right now we're just looking at that implied dealing range. Okay, so that's criteria 2, right? We need to understand where the discounted and premium areas of our implied dealing range are. So let's make this 50% green and recognize that everything underneath this is considered to be discounted and everything above it is considered to be premium under the context of buy side delivery. We're not framing any sell side delivery. Very critical. I will keep emphasizing the words under the context of some sort of delivery because it's not a pattern. You need to be trading with the narrative or else this concept doesn't make any sense. Okay, that's the first concept that we use is swing grading, right? To see where's discount, where's premium. Now we want to look at the first criteria, which is going to be the best pyramid or new positional entries will have an entry at a bullish breaker, right? So a bullish breaker, like we talked about in the beginning, is going to look something like this. Let's use the 4-hour chart, like again, because we just want a clear candle. This candle up in here is a bullish breaker. This was an old bearish order block, right? That delivered sell side delivery. So as we trade through this candle, really the body, we can look at the body. Let's refine it on the hourly and just find, this body. Right? As we trade through this body right in here and we expand, this becomes our bullish breaker at EQ of the range. So it's still in the discount of the range. Fantastic. Here is going to be the best area to add to this smart money reversal if you're trading these higher time frame charts, like this 4-hour chart. If you're trading this 4-hour chart, this area is the best area to add to this positional long. As you get higher into this silver bullet area, we've talked about swing grading, there is going to be, less ideal ads in my opinion because they become more and more premium. When you're entering a positional long, you want to position yourself predominantly in discount. Doesn't mean there's not entries in here. We traded on Tuesday and we traded on Thursday and we traded on Friday. But if you're swinging, you wouldn't want to swing past, I believe, to be this area of price, right? Because again, you're looking to pyramid in to an original position. as you can see, once price closes through this bullish breaker, what I'm going to ask you to do is look for 2 PD arrays to consider adding to. This doesn't even have to be a lesson on pyramiding. This can be pyramiding or taking new entries, right? Because sometimes we talk about, usually we like to enter at the LRE. What happens if you miss it, right? This is essentially answering that question. What happens if you miss that low risk entry down here? There is options to add, and this is going to be what pyramiding looks like. So we want to look at order blocks and FVGs as pyramids, right? Again, in this premium discount area of the range. What I'm going to suggest to you, and I just made a post about this before the lesson because I wanted you guys to backtest this after, is I want you to now consider down closed candles that sweep liquidity, form SMT, engage the breaker, okay? That is going to be your A plus OB pyramid or new entry. Boom. This is something that I have backtested, and you will backtest for yourself to confirm. You want to look for the down close candle inside of this breaker that engage the breaker. So the opposing candles that engage the breaker that A, sweep liquidity, B, form SMT. If you have the, or I guess you could also say this is also another one, right? So it has to engage the breaker. That's always a rule. Sweep liquidity, form SMT, or rebalance A inefficiency. You guys notice where am I drawing all 3 of these things from? My OB lecture, right? This is all drawn from my order block lecture as the best order blocks. Now we're adding the caveat of those candles that engage the breaker. That's something we didn't talk about before. This is how we're going to use it now. So in this price leg, as you can see, once we get a closure through the breaker, when does that happen with a clear displacement? You could say it happens, with this candle here. That makes sense. But I would actually argue that we have a better breaker to choose because we're consolidating in this range, which is going to be right here. As Monday just puts in this super choppy range, like we're just seek and destroying, we have a very nice, right? Because we just chop all Monday, right? Very nice up close candle, which is an old, right? What is this? Old selling, new buying, because we sell off. So as we close through this up close candle, I want you to look at these candles that come into it. What do? We sweep out liquidity, right? We form an SMT. We form an SMT that's very large with the YM, right? And we also rebalance. There's no inefficiencies in here, but if there was an inefficiency in here, maybe on higher time frame chart, that would also be another nice indication. Oh, there is. Perfect. There's an inefficiency right in here, okay? So this meets all 3 of our criteria. There's that 4-hour volume imbalance right in here, okay? This meets all 3 of our criteria. So I'm going to put this in here just so we can keep it side by side. These down close candles in here sweep liquidity, form SMT, rebalance inefficiency, and they're inside a discount of the implied dealing range and in a breaker. This is where you want to add to your position if you took a long, with the low risk entry, or you want to take a new position. Where? At the open of these candles. Okay, that becomes the order block. Right here is a good one if it closes through, or I would just use the series right there. Okay, so I'm gonna take a picture of this, put it in the chat, and we're gonna do several more examples to prove it to ourselves that this is how the best new positions can be taken. If we add in premium, what will be our stop loss? As always, you're gonna use market structure. You can add in premium. As you can see, there was lots of ads in premium. There's one here, which is in premium, right? Which happens in another breaker. Now, the reason why I'm teaching you to enter in discount is because it's going to be more optimal in terms of your risk to reward. Now, of course, mitigation is going to support all the way through, right? Mitigation, if you have a buy and sell side of the curve. Mitigation doesn't just stop at the halfway point and then fail up here. No, mitigation will work here as well as in the final quartile. Mitigation will work, but the ideal mitigation for your entries is going to be below 50%, because then you're getting the best risk to reward. Now, I'm teaching you guys this on the hourly and 4-hour charts. You're going to go back in your homework, obviously, and you're going to be studying this in the 5-minute and the 10-minute and the 1-minute charts, because it's all fractal. But let's take a look at this entry right in here, okay? So this is going to be our bullish breaker under the context of buy-side delivery. I'm going to keep saying that, because if you're shorting or if you're longing, right, these down close candles on the sell side of the curve, you're going to have a hard time. So here we go. Bullish breaker. Extend that out. Wait till price closes through. Now, the down close candles that engage the breaker and follow these criteria are what we're looking for. Let me just get rid of all this shit in here. Okay? Well, which candles do that? We close through, right? We come back in. We're waiting for the down close candles that do the following things. I don't see this down close candle sweep much liquidity. I'm not going to use that down close candle. I'm going to wait for liquidity to be generated. Then we sweep liquidity here. Boom. Again, it's important that we look at why this makes sense, right? Why do we want to wait for a liquidity sweep? Because again, as price is being mitigated here, we have a handshake. There is a handshake between old sellers and new buyers, okay? So old sellers are saying that old sellers are buying to close, right? Which is being paired with old buyers selling to close, right? So as your position moves into this area, people who want to sell the market, right, and offset their longs, right? They bought here. Say you bought right here, and you want to offset your position here. There is a willing counterparty on this side of the curve, which are the old sellers who are buying to close. So they're mitigating at that area. Now, what we want to do is wait until we have an order block priced into this area that A, sweeps some sort of liquidity, B, forms SMT, and rebalances inefficiency. So in this case, let's see if we form any SMT. Yep, let's see. There it is. All right, there's our SMT divergence right here with the NASDAQ lows. Fantastic. Okay, so this, that meets all of our criteria, right? Sweeps liquidity, forms SMT. Does it come into a higher time frame imbalance? Yep. Right? Well, no, it doesn't. There's no 4-hour gap in here. Nope, it's just a sweep. So it doesn't meet that third criteria. It's fine. It doesn't need to meet all three. It's better if it's all three, but it's the same thing as my order block lecture. We're looking to grade this order block. So now, where do we want to position ourselves for our new position or our new entry? At this candle's open. See? The down close candle in the breaker that sweeps liquidity and forms an SMT. That is going to be the place where, say you added here. This is your position. Say you're a positional trader. There is a valid entry. Stops below the SMT low. There is another valid entry. Stops below the SMT low. Your original position that you're pyramiding to is the low risk entry. Say you got in here, right? That's what you're adding to. Now, this is the same as taking a new position. It's not different, but I'm teaching it to you under the context of pyramiding, because when you start to see this in your lower time frame MMXMs, you're going to realize you can add to your winners. You don't need to add to losers. There is a narrative for why price reaccumulates and why it redistributes, because it's forming these areas of mitigation and then moving away from them after mitigating orders in the market. Okay? So this is a very clear example of the ideal, right, entry in a mitigation zone, or a breaker block if you want to call it. And this is how I suggest to pyramid. Now there's also the idea of doing this with fair value gaps. So I'm going to get rid of all this shit again. And now, wait, I'll take a picture of it so you guys want to see. Right. Let's zoom out a bit. Put that here. Zoom out. There you go. Copy image. Okay, so that is mitigation underneath the buy side of the curve, under the context of buy side delivery, and how you add or take new positions. Now let's do the same thing on the sell side of the curve. Maybe let's look at an example with a fair value gap. So I'm going to refer back to this 4-hour sell side of the curve. Remember, we first have to recognize what side of delivery we are in. This is sell side delivery all the way until we come in to this external low, okay? So now I'm looking to see the exact inverse of what we just did on the buy side of the curve. I'm looking for old areas that functioned as bullish order blocks. This is a bullish order block that is a high confluence order block. Why? Because it A, sweeps liquidity, right? It B, rebalances this inefficiency, all of this inefficiency, and then it C, displaces away, forming a balanced price range. This is straight from my OB lecture 1, okay? You have to pick a good bullish order block if you want to pick a good bearish breaker. There's no such thing as a good bearish or bullish order block. That's a bad breaker. A bad order block will be a bad breaker, but the lesson today is not to teach you about breaker blocks, to teach you about the context of mitigation, how you use it. So let's use the same formula we had before. What are we looking for now on this side of the curve? An implied dealing range. Let's start with that implied dealing range always. Again, this could be a 1-minute chart. I'm just using a 4-hour chart because higher time frames hold higher power, obviously. But this could be a 1-minute chart. It wouldn't matter. Here is the context of sell side delivery, okay? Here are levels. Everything above this 0.5, right, is considered. Now let's change it to red. This is premium, where we want to be involved in. Everything below is discount, where we don't want to be necessarily taking new positions, and they're less ideal if we're pyramiding. So how does this look? We have this bullish order block, which again is the same thing as me saying a bearish breaker under the context of sell side delivery. Fantastic. I'm going to keep writing it out in all those words so we make sure we're thinking of narratives first. We're waiting for price to close through this. Okay, price closes through this energetically, activating this bearish breaker. Now we wait for the series of up close candles that engage that area. We have this 1, 2, and again, if you go down to a lower time frame like a 1-hour chart, you will see that there is this up close candle in here that comes in, right, which is the wick of this 4-hour doji. So we'll use these candles, and this will be our order block. Now, as price refers back in to this order block's open, that is an ideal location to add to your position. Now, what do we also look for in here, right? We want to see if this order block in here, what do we want to see if it did? We want to see it do a couple of things, right? First of all, engage the bearish breaker. Check 1. Check 2, it comes in and rebalances this inefficiency, okay? That's another plus, okay? Let's make this as a gray color. Whoops, that's too dark. Let's make it this color and just make it very faint. Okay, right? It comes in and rebalances this. Can you guys even see that? Okay, it rebalances this. Check 2, okay? Right? First check. First step comes into the bearish breaker. Step 1. Step 2, rebalances the PD array. Good. This is a good order block to consider for a pyramid entry or a new position. The next thing we want to look for is SMT. Do we see the SMT? There is our smart money divergence. Fantastic. This order block is a very high confluence order block because it has engaged the bearish breaker. It has distributed, right, from the fair value gap and then traded lower. When price comes back into here, that is a good entry for shorts. Okay, let's do another example. Again, let's try and stay in premium of the IDR, right? And maybe we can venture into somewhere in between here. Zoom out. Where's another high probability order block? I can already see one on my chart, right? These in here, all of this price action in here is already encompassed when we trade back into it here, and then we have a short-term reversal. So I'm not considering this here. I'm considering this one here, and then I'm looking for another down close candle. Okay, and here it's still encompassed by that move lower, so it doesn't matter. We already got that entry here. Let's look at the next series of down close candles that's not encompassed by this move lower. So we're looking for new mitigation, right? Whereas price failed to mitigate yet. Fantastic. Here's a new mitigation area in the market. As you can see, this is getting into that premium, but let's see if the weight still holds, okay? Let's look at a lower time frame and see if we can frame something similar to that. So I'm going to copy this, paste it in. Let's go down to an hourly chart and see if we can find some up close candles in that area. Nope, these up close candles don't even engage it. What about a 30-minute chart? Ah, perfect. Okay, so we close through, right? Let's refine this order block on the 30-minute chart again, just so it's all the same time frame. Okay, there's the bearish order block. Whoops. Again, this is more premium, but the concept is what I'm trying to emphasize to you. Bearish order block, right? Or bearish breaker under the context of sell side delivery. We have a closure through. We have this up close candle. This up close candle, once this came back into, becomes an order block, right? We want to see if it does a couple of things. A, does it sweep liquidity? Well, let's see if there's an SMT here, first of all. That'll be important for us to gauge. Whoa, there's equal highs. Oh no, NASDAQ, there you go. Oh, I don't know, actually, it might be equal highs. Who knows? I think it's equal highs. In this case, NASDAQ creates equal highs. Does the YM form an SMT? Ah, yes, the YM does form an SMT, right? No, it doesn't even. Not with this candle. Okay, so again, in this case, it's just NASDAQ with the equal highs there. So it's not the best example. But again, this order block open is another good entry, right, that we can consider for a short. I actually wouldn't take this one because it doesn't form SMT at these highs, and it's still premium. But the concept is what I'm trying to emphasize to you, right? And then you want to be targeting the implied dealing range low, right, which is going to be this sell side right here. Okay, so same thing on the sell side of the curve. So I hope you guys can see the concept today is relatively straightforward. What we look for, right, I'll summarize again, what we look for when pyramiding is the following. What side of the curve are we on? This is the context. 2. What is the implied dealing range from 0 to 1? 3. Which failed order blocks or breakers can be utilized for areas of mitigation? 4. In these mitigation areas, how are the down close candles trading, right? Are they sweeping, forming SMT, right? Rebalancing, and then, or also, and the other thing is, in these mitigation areas, how are fair value gaps forming? That's the last thing we need to talk about. So I have now shown you effectively pyramiding using order blocks. Pyramiding using order blocks in breaker blocks, okay? You've learned how to pyramid using OBs in BBs, okay? Properly, with the right context, not just taking any order block. No, you need to see certain things in those down close or up close candles. Now let's talk about in the mitigation area, how are fair value gaps forming? As you guys are gonna know, this is a really hot concept. What's this called? This is why I don't even teach it, because everyone already knows this and it's overused and it's completely pattern based, and half the time it's completely fucking bullshit. There needs to be reasons, but people love this setup. What's it called? Unicorn. Yeah, everyone knows it because everyone has heard it. Because everyone is it's very, very, like, It's very, very patternistic, and it's very, very topical, right? When people talk about, like, what are the best entry patterns, you'll have a lot of people saying, oh, well, unicorns are the best entries, right? So here we have our unicorns. So let me show you a few examples of how those work. I prefer to use this method. And I prefer to use down opposing candles or order blocks because there's usually some nice narrative of SMT inside of a fair value gap anyways, and there's a sweep. It gives me 3, 1, 2, 3 confluences that area that's swept, right, is going to be a protected low to move higher so I can trail my stop loss there. I don't like using intermediate term lows as just a fair value gap. So if I have a gap, right, I extend that out. I don't like to just necessarily use that as the intermediate term low. I would rather use the order block and then say now it's the intermediate term low, if you guys know what I mean. It's why I use order blocks a lot more than fair value gaps personally. For me, it gives me more narrative. Anyways, let's take a look at this example where we now have fair value gaps in these areas of breakers, and now close it off. Okay, so let's go back to our 4-hour chart again, right, and try and find an example where we can use a fair value gap and a breaker in combination. Let's look for some maybe older price action. This is nice. I have an implied dealing range high. I have a smart money reversal down here. Let me draw out my swing grade or my implied dealing range, whatever you want to call it. Okay. Everything below 0.5 is discount, is where I want to look for, but we'll also look at the arguments all the way up to the high. I'm just saying when you're starting, keep that as a potential area where you no longer consider new positions because you're now in a premium range. Now, of course, we know the silver bullet's going to happen in this last step, as you can see right here, but this is going to be the best. Let's take a look at where the potential adds are. So say we get involved in this low risk entry down here, smart money reversal, low risk entry anywhere in this, bottom quartile. Now we want to look for mitigation. Fantastic. Zoom out, look at this side of the curve. Yeah. Again, this is our low risk entry. So this mitigation also acts just a low risk entry, so there's no point in looking at it once we trade through it, because we've already had this trade through, come back in, take the low risk entry, and now we're just chopping. Wait for price to actually leave this LRE range. Okay. So now we have these series of candles. Beautiful. This is again our bullish breaker or failed bearish OB. Same thing. They mean the same thing. Now we want to look for the example of a fair value gap. Overlapping the series of candles, or you can choose the single candle. Again, this is how you interpret order blocks. I will tell you the series of candles, right? Inside this series of candles, you see we reprice a fair value gap. This 4-hour unicorn, right, is another potential entry. And what you want to see in here, what I would argue is more important to see, is not only rebalance of the FVG or unicorn, but I encourage you to look for SMT or PD array divergence, okay? In here, if you can see SMT or PD array divergence, that gives you more narrative than just simply the fair value gap. So let's look in here and see if we can see anything like that. Inside the gap, right? Fantastic. Let's look at this. This low is taken. This low is not taken on either. Is there another fair value gap it comes into though? There's 2 fair value gaps here, right? There we go. Okay, so there's a PD array divergence. In between this candle and this candle is another fair value gap that price comes into on the ES right there. And then we'll mark it out on NASDAQ as well. There we go. There is our PD array divergence. Fantastic. That's what we wanted to see, right? So we're going to call this our PDA divergence. Inside this unicorn, that gives us the narrative. What do you think I would do? I would wait. Whoops, I opened my Keynote by accident. I would wait for price to now close above this candle, right? or above the order block, and then I would enter on the order block personally, instead of just risking in here, because it's also 2 in the morning. I would now use this coming into the New York session, right? Look at this, 6 a.m., 10 a.m., power of 3. I would now be saying, as soon as price can close above this candle, right? Now we're set to go. So as you notice, this happens kind of on a lower time frame. It probably closes above the hourly and then retests. And then, of course, it comes back in later, right, to these wicks. But I would use the order block. You can use a fair value gap. It's up to you. That's a good entry right in there, okay? Let's take a look at the next one. Again, we have another closely overlapping bullish breaker, failed order block, right? Again, what do we wait for? Wait for price to close through. Now we're looking for a fair value gap in this range. Fantastic. Let me get rid of this lower one. Let me make it a different color just so they don't look exactly the same, okay? Here's another one. Fair value gap in here. Perfect. What do we want to look for? Some sort of SMT or PD array divergence, right? Look at the unicorn. No SMT there. There's no gaps even in here. So NASDAQ is not the index you want to be longing in this day, right? There's no gaps in here. But I would still consider this to be a PD array divergence because there's no fair value gap in here. So this is, again, PDA div. Because there is no gap even on the NASDAQ, you can see. There's just wicks. And therefore, PD array divergence, good. Long that again. Again, what would I like to see? And I probably wouldn't long again at 6 a.m. And maybe in this 9 a.m. candle you could. But again, you can also wait for the order block, right? This candle that comes in, or this candle even as well, right? And you can wait for that. And then there's a fair value gap in here as well. But you can take the entry there if you want to. So that's how you can use the ICT unicorns, right? Where is the... I used to have like a unicorn symbol. No, where'd it go? Let me find it, guys. I'm not gonna look for it. Okay, this is where you can use your unicorns, okay? This is where your unicorns can be utilized, or you can utilize or down close candles. Doesn't matter, it's up to you. In this case, you have fair value gaps, so you can use the unicorns. If you don't have fair value gaps, you can use the down close candles. And then again, up into here, I wouldn't consider any more entries, right? Like I would not, for example, utilize this breaker with the same logic because I don't know if it's going to go higher after it reaches the implied dealing range high. It actually ends up coming back into the range a bit more. And then you can see, where's another good example? Here's a new implied dealing range, right? Look, just this one right here. This market maker model right here. Same concept's going to apply, of course. Okay, so look. We have our low risk entry, right? Again, a low risk entry utilizes and employs the use of a breaker. Okay? Breaker on the, so a failed order block, close through, overlapping. We have this fair value gap. Here's your ICT unicorn setup. What you can also do, if you want to be more certain, is wait for price to close above these down close candles that come in. Then you're using an order block entry. That's a valid entry. And technically that's a valid entry too. I would wait for the order block because I want more confirmation. And I'll do it in a lower time frame, not the 4-hour chart. In the 4-hour chart, I would zoom into here. Like for example, how would I actually navigate this? When I saw that happen, I would go down to my 15-minute chart. Let me show you exactly how I trade this using both concepts, right? I go down to my 15-minute chart. I would see that, right? That reaction from the fair value gap. And again, I would use opposing candles. So I'd be like, okay, fantastic. Once I get this change in state of delivery right here, right? Now I want a long when price returns back into this order block. So I wait. Oh, this is 3 in the morning. Let's wait till the kill zone. Extend out my SysD. That's the SysD that matters because we're in the 4-hour gap. But wait because we come back into the 4-hour gap in the AM session, right? Here's the AM session. We come back in the fair value gap. Let me get this change in state of delivery. Here, higher, perfect. When does it market open? 9:30 or 8 o'clock. Let's see if there's any entries kind of at 9:30ish. Just wait for it to come back into maybe. Yeah, nothing super clean here. This is really choppy, but this would be the entry, right? Comes back in, and then you target, and then you're refining, right, that 4-hour zone into the implied dealing range high. Something like that. That's why I would trade it. Day trading it, obviously. I'm not trading the 4-hour chart usually, right? I'm not usually swing trading. I'm usually day trading. So that would be how I approach trading from this area in here. Okay? So that's how it works, right? Let's take a look at one more example, and then we'll call it there, and you guys can just do some backtesting. Let's do another example from a long time ago that we don't remember. I don't know why I'm only using ES. Let's do something on NASDAQ. Let me see if there's any questions. Yeah, mitigated or unmitigated order blocks can both be used. Yeah, it depends on the time. It depends on the time at which they're mitigated. If they're not in a kill zone, then I'll wait for them to be mitigated or retagged in a kill zone. Yeah, the kill zone is very important to me. Okay, let's look at NASDAQ. Let's do an example on NASDAQ. Okay. Let's go to a really old piece of price action like here. Fantastic. Very nice. Smart money reversal down here. I can see that. Implied dealing range. Anchor from the low. My implied dealing range would honestly be in this 4-hour chart. Let's just stick with the most recent one. But I could even say up here, but whatever. We'll just stick with the most recent implied dealing range, right? Cool. Perfect. We have somewheres to look. We have a nice low risk entry. We get nice expansion. Again, same approach, right? Here is this candle at the Q of the range. This becomes our bearish order block that has failed, becoming a bullish breaker. The bullish breaker, we have these down close candles that come into them. Right? Boom. Price doesn't fill you, but that would be the entry, right? If price gave me a fill right here, that's where I would long, right there. Right? Boom. Same exact concept. Let's go to the next entry. Right? Now we're moving a bit more premium. But again, wait for price to close above these candles. Right? Nice silver bullet area here for that LR run. Price closes above. Fantastic. Waiting for the down close candles that come into there, or the fair value gap. In this case, you can clearly see this 4-hour fair value gap, right? And you want to target that high, so you're not going to wait until price closes above this candle, because then you have no entry, right? So in this case, obviously, you're going to use this fair value gap, which overlaps, right? This breaker, you're going to look for what? So we say SMT. Let's find that SMT, baby. Let's find that juicy SMT. There's the SMT. Inside the gap, rinse and repeat, go long. Do you see how the same things happen time after time? Now, I can see we're still clearly bullish. Obviously, look at that candle closure. So where am I going to anchor my IDR to? The high now that I'm expecting to be ran. It's all LR, right? So now I can still go involved and look for more breakers, right? Okay, here's a nice breaker, here's a nice breaker. Where else is a really nice breaker? Well, price expands. There's nothing in this. If I expand this consolidation, there's nothing of interest for me over here. So there's no breaker. There's no pyramid here. Okay? No pyramid for me. If I'm swing trading, I'm not pyramiding in this gap. I would rather wait for a new breaker. Right? I mean, I think this is like, you would add here. You wouldn't add here, but you'd add here and you just hold. So this breaker right here is really nice. As you can see, price just explodes through it with a CPI candle probably. So let's see if there's anything else we can look at before this high is met. Doesn't even look like it. I mean, maybe we have this very, very premium breaker up here. That's about the last thing I can see. But yeah, as you can see, this is so premium that price is not really going to be as cleanly respecting that, right? Look at that. You wouldn't want to take an entry in here, guys. In here, that's a red zone. This is shit. Ew. Like, this is disgusting, right? Trading long to here looks like that. Nah, it's not for you, right? And then again, then we're at all-time highs. So then, I mean, then there's no more. Then once price starts doing this shit, there's no more mitigation, right? Oh, actually, never mind. What am I talking about? There might be some daily mitigation. Let's do it on the daily chart. Let's show it's all fractal. This is, I like this highest high. Let's use these candles. Let's expand them out. Look for some daily mitigation and use the exact same property, okay? Daily mitigation, what do you see? Overlapping fair value gap, very nice. You're going to see SMT here as well, of course, right? Go to your chart, prove it to yourself that you see SMT in that fair value gap. There will be SMT here, guaranteed. Guaranteed on my mama, on my father, on my everything, right? There's the SMT. Wait. Uh-oh. Uh-oh. Oh no. No, surely. Maybe not. Let's check the YM. Maybe I just capped. I could have capped you guys right there. Let's edit it out. Editor, edit that out. Edit that out. Edit out me saying there was definitely going to be an SMT in here. Let me look at the YM. There we go. Right here. Perfect. I was never wrong. I would never lie to you. Okay, there's that daily SMT. Beautiful. Perfect. Now we go long on the daily chart, right? Where do you long to? From here, right? I would again use what? Wait for the opposing candles, long the order block, right, when it comes back in, and then just, I guess I would target 2 to 1R. I'm at all-time highs, so it's kind of hard to trade this, but you kind of want to risk, I guess, this swing low rejection block and target 2 to 1R. There you go. You get 2R. Right. So yeah, you can use it on the daily chart too. It's pretty cool, right? So I want you guys to convince yourself through your back testing that what I'm showing you is applicable to all time frames always. It's how the market books, right? We'll do one more last example, and then I'm going to head to dinner. So let's look at this sell side of the curve, okay? Call this our smart money reversal. Right? Let's do an implied dealing range. I hope you can see how quickly we can start to do these things when we're back testing. You can prove it to yourself very quickly. You can back test hundreds of time frames, hundreds of examples in like a couple hours of back testing, right? It's very easy for you to do that, so do it. Okay. Let's say that's the implied range low, but actually let's zoom out. This is the daily chart. Yeah, let's just say that's the low. This is probably a look back function, so let's actually use that. Let's actually do it just like we were trading this. Where's the daily MSS? I'm going to use this SysD right here. Yeah, that's it. I want to target that low though. let's target that low. Wow, that was a tiny ass range, I guess. But let's say that's the low we're targeting. Ideally, it'd probably only be this low, and in this case, there's only. I mean, fine, fuck it. We'll do it to that low first. Okay, we'll do it to this low first. Right, we're just chopping. Then we want to look for some old bullish order blocks that fail. Okay, there's your old bullish order block that fails. Now we want to wait for price to close through it, right? Now we have to wait for an up close candle to be repriced, and as you notice, there is nothing. So let's keep going lower and use a higher time frame dealing range because we want to see at least one good example of this. So as you can see, price displaces through all of these lows. Let's use all of these candles. Let's actually just maybe even use this one. I would actually use all of these candles. Perfect. Price comes back in right here. Now we have this fair value. But see how there's multiple fair value gaps in here? This is why I like using the order blocks a bit more, because you can wait for the opposing candles that lead into this range to be closed through. If there's an SMT right here, I will use these candles. If there's an SMT right here, I will use these two up close candles. Let's see. Boom. You guys see that? Beautiful. Beautiful SMT. I can use these two candles. I have the context. I short this candle right here. Look at that. Zero drawdown. Cover the SMT high. If you're pyramiding, you're targeting the range low. This is magic. That's a beautiful entry. That's a perfect example, by the way. This is like an A+ example right here. SMT at the opposing candles that trade into the order block, into the breaker, form an SMT at the highs, right? Inside this fair value gap, right? We're also mitigating a weekly fair value gap in here. Look. You can't make it up. This is a perfect example, guys. If you want an example of how this works, use this example on the daily time frame. Because this here, in here, there is a BRK plus a weekly SIBI plus SMT at daily highs, SMT highs. That's a perfect example right in here of an entry, right? And you're targeting the low, right? In this case, you're targeting 2 to 1R. You're not going to target all the way to low because you see it comes back, but you're going to target 2R. Or maybe let's say these lows. That's a nice draw on liquidity. But I would say just always target 2R. Boom. Fantastic trade. Comes in, liquidates these draws, comes back up, stops you out, right? Let's look at one more example in this dealing range. Okay, I'm gonna take a picture of this because this is the best example that we've done so far. That's Chef's Kiss, yeah. It's really nice because it meets all the criteria we're looking for. Okay, let's look at one more example. Again, we want to reach into terminus. Maybe we even want to reach into these relative equal. Oh, I see a double bottom. Okay, that's my draw. Okay, that is now my draw. So let's see if we can get anything else before we get to that double bottom. I really like these candles up in here too. Again, why do I like these candles? Because it's a very obvious bullish order block on this side of the market. I'm not going to teach you order blocks. I've already done that. Look at that precision, right? That's algorithmic as hell. But regardless, price comes back in to this breaker. Now again, it's a daily chart, so I don't want to just slam randomly the first FVG or sweep I see in here. Obviously, you can see here we come in, we sweep. So remember the criteria I said. We want to look for the opposing candles that sweep, lead to SMT. Surely there's going to be an SMT here as well. I like the daily chart because the examples are so clean. It's YM. Let's see if YM forms some sort of divergence here. Oh, they actually all sweep. That's interesting. None of those highs were protected in the market. Interesting. Anyways, doesn't form SMT, but it sweeps the opposing candles right here. Beautiful. That's the order block open, right? That order block overlaps a fair value gap as well, so they're really just handing this to you on a golden platter of this is the best short to take. Right? Very obvious short to take. I would just short the fair value gap order block combo, right? Really nice. Because this is, again, breaker, sweep, fair value gap, order block. Short that shit, cover the high, 2-to-1, right? There you go, 2-to-1, and then the draw on liquidity. Like, these are really clean examples, and I hope you guys can see this is not just one time frame, right? You can do this on any time frame. We can go to a 5-minute chart, and I'll do one low time frame example, and then you guys are obviously, I know, going to be back testing lower time frame examples because that's how you trade. And so as I trade too, so I'm not saying you guys are different than me. I'm just saying it's better to learn on the higher time frames because there's less noise. But let's take a look at ES last year on Friday because I used this concept on Friday, right? I used it throughout the day to take new positions. Implied dealing range. Okay. There you go. That's your implied dealing range for the day. Here's your smart money reversal down here. Now what we want to look for is old mitigation. Look at all that gross shit. What time frame can I see one nice candle that looks nice in here? I don't want to look for like a big, there we go. 15-minute chart look decent. 15-minute chart's the only time frame I can see one clear candle in here, right? The rest of them look like dog shit. Sorry for my language, but there's nothing else that looks nice in here besides this 15-minute chart. There you go. There's my mitigation, right? Breaker. Right at EQ of the range. Price trades through the breaker. Now I'm looking for the opposing candles that come down into it. Remember, we traded this, and we tried to enter in this fair value gap when the much better entry, right? This is the unicorn in here, right? There's your unicorn. There's also another unicorn. Where's the other unicorn? Here, right? Here. But actually it's much deeper. The better entry would have just been this, right? Look. That's the better entry. Look how little drawdown there is. That's why order blocks over FVGs, in my opinion. Because look, take the order block, target the highs. You have a nice low that you can cover, right? A rejection block right in here. Boom. Great trade using the same concept, right? And you're actually blessed with one more very nice, clean, premium breaker, right? Does it close through the body high? If it doesn't close through, it's not a valid breaker, but we'll see. Nope, it doesn't close through the body high until here. Oh, it does. Oh, wait, it does. So it closes through the body high, comes back in, and engages this down close candle. But that's not really a fair example because we would have wanted to see it before. But again, just look at the precision of down close candles, right? Especially in these areas of mitigation, no drawdown, zero drawdown, and just one directional to the draw. All right, so on Friday, you can see we kind of jawboned ourselves here in the morning. What we should have done is just waited for a clear, right? Well, first of all, a clear break above this range. And then in here, we want to wait for these opposing candles to offer us an entry. So as you could have seen, the SysD was here on the 5-minute chart, right? We come into the fair value gap. Here's our changes to delivery, right? And then price doesn't actually engage this, but it comes back into the 15-minute one, I believe. All right. I don't know where that 15-minute SysD is. Let me point it out. 15-minute SysD is right here. Never mind, right there. So it didn't come into the 5-minute SysD, but it came into the 15-minute one, and then boom, right? So that would be a very good entry using this exact same concept, right? Let's do one more 5-minute example because I have a little bit of time. We'll do it from a previous day. Let's do it on a day that didn't look like that, so we can actually have a good example. This is nice. Okay. Where is the draw, though? Let me find my draw. I mean, even if we're just using this dealing range, fine. Data highs. Data lows. Data highs. Small dealing range. Definitely more of a scalp, but smart money reversal. Right? I want to look for us to close above, up close candles. In here. Boom, right? I'm going to order block that overlaps it. That's a decent entry. But again, let's use the same criteria I've taught you only, which is to wait for these series of opposing candles into that order block. Or into that breaker block, sorry. There's the breaker, right? Opposing candles in. Fair value gap as well. Look, this is your ICT unicorn, right? Unicorn setup right in here. Fantastic. Is there a divergence? There should be. Let's see. Yeah. What is this called, guys? What kind of divergence is this called? Everyone say it with me. What is this? What is this? What is this? What is this? Fair value gap, no fair value gap. Fair value gap, no fair value gap. What's that called? Yeah, divergence. Yeah, everyone said it with me all at the same time. PDRA divergence. Yeah, look, right? Perfect. Now we can wait for the opposing candle that comes into it, right? This candle right here, close above it, go long. When it retests, look at the body just beautifully hold. Like, again, let me get rid of the swing grade. Look at that. Look at the bodies holding the open and that opening level so nicely. And then what do we target? Data highs. All right, risk, PDRA divergence. So that's how we can actively use mitigation, actively in the market to support taking entries. You're never, does this give you guys faith that you don't have to ever FOMO into an entry? You didn't miss it. Like, say for example, you don't catch the news distribution here like I did on Tuesday morning, right? That's okay. What you can wait for is the mitigation. It will present itself. There will be a chance for reaccumulation in mitigation. So there we go. We close through, right? Fair value gap. Here's your unicorn setup. Another ICT unicorn, right? You can also use the approach I use, which is to wait for the opposing candles to be closed through. Here is your order block. Take the retest, break above, retest, right there. Where are you risking, right? Risk this low. I would actually risk the data lows or the rejection block, right? And then where am I targeting? 2 to 1R, right? It's the same. It'll work. It'll always work. Look, right? You just look left. All we have to do is look left and have a clear market maker model to establish. Even when it looks like shit, it works. Like, look, this looks like shit. Like, this is disgusting. But look. Breaker, right? Okay. Wait for us to close through the breaker. Here we close through the breaker. Come back into it. There's no fair value gaps, nothing. So I'm going to wait for the opposing candles. And I will only use this one, right? If there's an SMT. If there's no SMT, I won't use this as a SSD. This has to form an SMT. If it does form an SMT, I can use that. If not, I have to use that, okay? So is there an SMT? No. No SMT. Unless this sweeps. Oh, it does sweep, doesn't it? Yeah, it does. Okay, I can use this one. It might be a double bottom, I'm not entirely sure, but I can use this SSD because there's an SMT at this candle low, right? Which is a PD array divergence. You can see the fair value gap in NASDAQ right here, guys. Right? PD array divergence. There's an SMT. I don't know, it might be double bottom, but if it was an SMT, I could use that. That's the opposing candles. Come in, retest that, target what? The high, stop loss below SMT. There you go, right? Boom, perfect. Right, it works. This stuff works on all time frames. Go to a 1 minute chart. Let's find a 1 minute market maker and prove it to ourselves. Let's use maybe an Asian session 1 minute market maker model where it looks like super shit and is super choppy. It's all the same thing. I'm not using ES, I'm using NASDAQ because I don't want to look at 1 minute candles in the ES in Asia. Okay, look at the market maker sell model in London. Okay. Nice order block. Right, comes back in, closes through, wait for an up close, wait till it closes through. Now it closes through, there are the up close candles, okay? These up close candles, all of these, wait for it just to come back below here. It's gonna take time. We're just like doing nothing for like 30 minutes here. It's fine. Wait. Closes through, retest, perfect. Get involved right here, right? Do these up close candles from SMT is the next question we ask ourselves. If they do, even better, right? Yeah, SMT formed above these highs. Perfect. And SMT formed here on our entry above these highs. Perfect. Okay, SMT is formed. There's the opposing candles. Enter right here. Risk the highs. There you go. Target the lows. Or 2-to-1R. Same concepts all the time, right? Mitigation, opposing candles, break a structure, or try to change that delivery. Get involved in that. Right? Look at the buy model right here in Asia, okay? Draw on liquidity. Strong range high. Comes in, smart money reversal, wait for a mitigation block. You don't need to trade in this if you do miss it. Here's a mitigation area, wait for price to come, but I'll use all of these candles, they're all mitigation, right? Price comes in, trades above, right? Comes back below, wait for the opposing candles that come back below to be traded through. These, take the retest, boom. Is there an SMT here? As we want to ask ourselves. Holy, that looks like terrible. Oh, I don't know why it's not showing me ES. Yep, I think there's an SMT right here, right? Oh, it might be a double bottom again. It's so hard to tell. Whatever. If there's an SMT, even better, right? Same concept. Along the open. SMT lows and the draw on liquidity, right? See, same concept. This is the idea of just using these mitigation areas as key levels to reaccumulate price. Okay, I suggest not doing it on a 1 minute chart. I suggest not doing it on anything less than a 15-minute chart. When you're day trading, the best entries that you like, if you miss an entry, right, in a day trade, say for example you miss an entry, 5 minute, 15-minute chart. Say for example this day right here on Friday you want to get involved and you just this shit all just shakes you out. Just wait till we close above these candles and then go for it. Look for something in this mitigation area in the PM session, okay? And as you can see, nothing happens. We just chop all day, right? But if we got something that looked like this, right? As you notice, we failed to SysD, but if we got a SysD here, could have done that, right? And then targeted London highs, okay? So that is mitigation, pyramiding, and essentially how to properly use breakers. Oh, hope everyone learned something. It's a good lesson. I use it all the time.